Hello, everyone. Welcome back. We have a very interesting session right now with Dan Young. He's going to be talking about performing due diligence on policies and how they're valued. He'll give you a great perspective on how to prepare and how to decide on which policy to proceed and give you a good overview of the whole process. It's my pleasure to welcome Dan Young, President of Magna Life Settlements, a longtime member of LISA, supporter and member. Appreciate it. Thank you, Dan.
Thank you. Hello, everyone. As he said, I am president of Magna Life Settlements, which is a provider, and I'm joined by Adam Meltzer, who's a senior portfolio manager at Magna. And I see from past presentations that I've sat through that there's a fairly diverse group of people in terms of knowledge of the life settlement market here. So we're going to assume not much knowledge about life settlements and really explain things as if you don't have a lot of experience doing life settlement transactions. So we'll try to really get into some of the issues we're going to speak about, but also try to explain some of the terms that we're using, which may be a little bit fundamental for some of you who are more experienced, but I think in light of the audience that it's appropriate. So the first question you might be asking is why there are two logos up there, Magna Life Settlements and Vita Capital. So Magna Life Settlements is a provider, which is a licensed entity that is regulated, that's allowed to transact life settlement transactions for people. And Magna is owned by Vita Capital, and Vita Capital is a funding source, an asset manager that has several funds, and it itself is an investor in the life settlement market. So we're a little bit unique in that respect, in that we effectuate life settlement transactions on behalf of outside parties, and we also have our own funding source and our own investing sources through our funds. With regard to the various markets in the life settlement world, there really are two. There's the secondary market and the tertiary market. The secondary market is the market where life insurance policies are purchased from people who took out the life insurance. So you decide that you want life insurance, you go to an insurance company, you take out that life insurance, and then at some point you decide you don't need it anymore and want to sell it. That would be sold on a secondary transaction basis. And in most states, those transactions are regulated and must be done through a licensed provider like Magna. And Magna actually is able to do business in more than 40 states, and in 2013 was the #1 provider in terms of dollars spent in the market. So we are definitely very active in the market and see most of the secondary policy flow. In addition to secondary market, there also are tertiary market transactions. Tertiary market are policies that have already been settled. So you have a person who took out insurance, he or she sells that insurance or settles it, and then the person who bought that, the investor, decides he or she doesn't want it anymore and sells that to another investor. That transaction is called a tertiary transaction, and that's much less regulated. Typically, institutional buyers and sellers are playing in that market, and those don't have to go through a regulated entity like a secondary provider does. And the reason for that is fairly apparent, that most of the states and departments of insurance want to protect their citizens, and their citizens are the people who own insurance, and they want to make sure that a licensed provider is involved in the transaction, because that licensed provider has audits from the Department of Insurance. That licensed provider has to have forms that are approved generally by the Department of Insurance. And there are various protections, such as compensation disclosure and things of that nature, that you would expect to find in a financial services transaction that are effectuated on the secondary market, and not as much when there are institutional players who have already bought and sold a policy. So, and you know, we have been a LISA member for a very long time. We think it's very important to have industry groups like LISA involved in the market. This is a market that has become more regulated. There are lots of rules and things going on in the market that some of which are very good and some of which need an industry group such as LISA out there advocating on the behalf of those participants in the market and making sense of it. So we're very happy to be here today. And the topic we're going to speak about is valuation and risk analysis. And the reason, obviously, that you want to understand valuation and risk analysis is that when you're purchasing policies or selling policies for that matter, you really want to understand what you have. You want to have an idea of what your policy is worth. And as we've talked about in the general session, nobody really knows when somebody is going to die, but on some basis we have to value these policies and price these policies to determine from a seller's perspective what a fair price is, and from a buyer's perspective and an investor's perspective, we really need to understand what we're getting, and we'll talk about some of the ways that we value that. Equally as importantly, at times, it's important to understand the risk profile of a certain policy, and we'll talk about what some of those risks are, because there are certain risks, and we come across distressed sellers all the time who didn't really understand some of the risks, and while they valued the policy properly, things don't always happen the way one expects them to happen. And you have to understand the contingencies and what the outcomes will be in those cases. You know, if something happens 90% of the time, that's a pretty good percentage, but that means 1 in every 10 times it's not going to happen. And so you have to understand what the contingencies are, what the risk factors are, because if you buy a policy and you can't stomach one of those risk factors if it happens, then you're taking on a great deal of risk and could become a great distressed seller, which for buyers like us is a good thing. We like buying distressed policies, but it's not a good position to be in, and we don't recommend it. So we're going to talk about some of the risk factors, some of the valuation factors, and then Adam's really going to take us through 2 case studies of some policies that we actually have purchased with some of the characteristics and try to emphasize through example what some of those characteristics are. Also, if you have any questions along the way, don't feel like you have to save your questions till the end. You might forget them. You might just decide not to have them. So just during the presentation, feel free to just raise your hand. There's a microphone in the audience, and we're happy to answer questions as we go. And if anything is unclear, even in terminology, we're happy to answer that. So the first thing we thought we'd go through is that there really are different ways to value policies. And in order to understand the 3 different ways that can be used to value policies, it's important to really understand what a life expectancy is and what it means and what it is not. So does anybody out there have a sense of what a life expectancy is? Anybody willing to step up? No? Some yeses that they know, but some no's that they're not willing to step up. So I'll just step up and say, life expectancy is generally a number which is, what it is not when somebody is expected to die. So when somebody says you have a life expectancy of 8 years, that doesn't mean 8 years from now at 12 midnight you're going to die. That's not what life expectancy means. What it means is that if you have an 8-year life expectancy, if you take a large group of people in a population who have many of the same characteristics as the person we're talking about in terms of age, in terms of impairments, and in terms of those kinds of things, 50% of those people in that large group are expected to pass away before the life expectancy date, in this case 8 years, and 50% are expected to pass away after that date. And so that life expectancy is the midpoint where 50% of the people are expected to have passed away and 50% are expected to be alive. So as you think about that, and you think about somebody who buys a life insurance policy and says, well, this is great. I have a life insurance policy, and life insurance the life expectancy is 8 years. So 8 years from now, I'm going to collect this death benefit. That's not the way it works. And so it could work that way, but 50% of the time, it shouldn't work that way. And that's where people get into problems when they don't understand really what life expectancy means. So in terms of the way you value a policy, these are the three ways. And Adam, maybe you can walk through each one of these.
Sure. So as it says, there's probabilistic, stochastic, and deterministic. And kind of starting bottom up, deterministic actually says what's the yield or the return if that person dies on the LE date, right? So you can look at it as if you make your acquisition cost a big payment day one. Every year you're making small premium payments, and then on the LE 50% day, you get your full death benefit. And in the early days of life settlements, a lot of people valued their pools this way, and if you look at some of the smaller guys today or some of the fractional investors, they're still using this methodology. Unfortunately, other people see the error in it as there is no way to predict the actual day of death, and if that's how you're modeling your cash flows, you're going to have issues towards the end of the life. Stochastic is running a Monte Carlo simulation, right? So however many simulations you run, that person, the probability of them dying throughout their life, and then it backs into a given yield. The vast majority of the market currently uses a probabilistic pricing model, including Vita. So a probabilistic model looks at the LE for what it is, right? It's a survival curve. Not only is it a midpoint at 50%, but you're looking at the slope up to 50% and the slope of the curve after 50% to see the probabilities on either end, right? And then you create your survival curve or your mortality curve and apply it to both the projected premiums as well as the projected death benefits. And in essence, you're saying, you know, how much death benefit would I collect today, and then back solve it as your IRR. And when you have a large enough pool, the law of large numbers kicks in, and it gives you a pretty high accuracy rate with probabilistic valuations.
That's a very important point with diversification. Our thesis with regard to investing in general in life settlements is that diversification is the key. So AM Best and others have said, so at the point where you have several hundred lives, you get predictability. The law of large numbers begins to help you get predictable and low volatility in terms of results. So, you know, if you think about it in a simple form, if you flip a coin 5 times, it's possible that that coin could come up heads 5 times in a row. But if you flip it 1,000 times, it's statistically improbable that it will come up 1,000 times heads in a row. It will come up more and more closer to 50-50 with the law of large numbers. And it's the same with life expectancies and diverse pools of policies. If you have policies where you have probabilistic pricing and you've built curves, and as we talked about, what life expectancy means, if you've done good life expectancy analyses, that people should live past your life expectancy 50% of the time, and there should be 50 or so percent of the time they don't. So if you build a large enough pool of those people and you put them on this curve, you can get a very predictable outcome as far as what types of maturities you'll have. Or said another way, nobody knows if that person is going to die next year. But what you do know is if you have a pool of 500 85-year-olds, an actuary can tell you with great predictability what percentage of 85-year-olds in a large pool generally die before they reach 86 and 87 and 88. So if you take the idiosyncratic risk out of the equation and say, I don't know or care if this particular policy is going to mature, but what I care about is having a large pool and knowing what percentage of policies will mature in each year, you can get a very predictable result. And ironically, that's exactly how life insurance carriers operate. They have actuaries tell them, if you have a large enough pool of people with these characteristics, this is the result you will have, and therefore this is the premium you should charge. And so the name of the game for life insurance carriers is to have a lot of life insurance sold so that their pools will be big enough. And it's the same with life settlements. Now, the challenge with that is that it takes a lot of capital, and it takes a lot of expertise, and it takes a lot of time to accumulate large pools of policies. So when you see it, you will see in the market people who have pools of 20 policies, and they could get lucky and have fantastic results. They could have average results, but they could have terrible results. You just don't know until you get to a statistic.
And with that, usually when you hear people with smaller pools or very 1 or 2 policies, and they talk about how great their results have been, what they're saying, or what they're really saying is, I bought 10 policies and I've had a lot of early results that have a very high yield when you look at those policies specifically, what we'll end up seeing is in 10 or 15 years on the back end of the curve that they're having single or less returns on the rest of their policies, right? It's all about tracking the entire portfolio compared to seeing the results in individual policies.
And in a way, and again, this may be obvious, it's actually much worse than in other asset classes to be in that position. In some asset classes, if you're wrong and something is not valued, you can just hold on to it and wait for it to come back. In the case of a life insurance policy, it goes without saying, you generally have to pay premiums. So if you have this idea in your mind that 8 years to the day, all of these policies are going to be matured, and I haven't really reserved enough to pay premiums 10 years from now because I know all these policies are going to mature in 8 years, lo and behold, you have 3 policies that haven't matured in 8 years, and now you're 10, 11, 12 years out, and you don't have the money to pay the premiums. Well, guess what? Your policies are worthless, and you are now what we call a distressed seller, and you call up somebody who's a buyer and say, I really need capital, I'm in a liquidity squeeze, and what can you do for me? And that conversation is a much less preferable place to be than a person who's selling because you're in a position of strength and you have an excellent asset that you want to monetize. So again, that may go without saying, but it's also so important, I think it's worth stressing. Any questions on these? Does everyone understand the three ways to? Okay, great. So these are some of the risk factors / valuation factors that we look at, and some of them are obvious, some of them are a little subtle, I think, and bear explaining. So we'll go through each one of these in some detail. So the first is probability of survival to maturity. So Adam, what do you?
Right. So definitely with policies issued in the 90s, which are starting to come into the market more and more, the smaller face policies that didn't go past age 100 and have a pure termination date, we started looking at the probability of survival to maturity very closely. And when you take your LEs and you develop your curves, you can see what the chance of hitting that date actually is. So from a pricing point of view, and what the case studies will show next is 2 policies that are relatively similar on the surface can drive 2 very different prices to the market. And this is one issue or one factor that really drives that. If there's a 15 or 20% chance that I can get 0 when the insured hits 95 or 100, which is happening more and more, then I'm going to price that risk appropriately, and that will show when you have to talk to your clients about it. If there's a maturity extension rider or the policy pays in perpetuity, then it's not a risk I have to worry about losing the whole investment.
So just to be clear, there are some policies out there where basically you're taking out insurance and at a certain point you agree with the insurance company you don't need it anymore. So at 95 the insurance goes away. It's almost like a term. And so there are policies that say at 95 or 100 the policy doesn't pay out if you survive that long. If you have one of those, our question is, what is the likelihood? If the person is 72 and has a 2-year life expectancy, it's very unlikely they're going to live to 100. But if they're 98 and have a 2-year life expectancy and the policy becomes worthless at 100, that's a big risk. And so we'll talk about that. And then there are extension riders that are on some of these policies that extend them past there. And if they have that, then this risk basically goes away. So life expectancy duration.
That's how long the LE providers predict on the curve basis.
Yeah, so, and it probably is worth saying that when we say LE, we mean life expectancy. And in this industry, there are 4 main life expectancy providers. These are underwriting firms. You've probably met some of the people here, 21st, AVS, EMSI, and Fasano. And they're generally firms where you will get medical information to them about uninsured, and they all have their own way of analyzing it. They have their own tables, their actuarial data, and they will come back and say, we think this is, usually in months, this is how many months this person has for a life expectancy, which again does not mean the person is going to die at the end of this number of months. So you'll get a life expectancy, and as Adam said, I think it's fairly obvious if it's a shorter life expectancy, which means You'll get your money quicker if the person lives less long, and you will pay less premiums, then the policy has more value.
As far as LE duration, why is LE duration a risk, or why is long LEs? I mean, I know they might value less, but why does it make a policy riskier?
What's your investment horizon, right? So all funds have different thoughts on whether they want to take higher impaired, and this kind of buckets in the LE multiplier issue as well, whether they want higher impaired or healthier seniors, and whether they're their fund is a 5 or 7 year investment horizon or a 15 to 20 year investment horizon. So you need, as you build your portfolio, if you're building a portfolio of 10-year lives, then you're looking at a 15-year funds. If you're building it with shorter LEs, then you have a shorter fund. So it's something that everybody takes in. You have to see how much premiums you're going to reserve and make sure that you have available capital in the future. And then, as I said, that kind of ties into LE multiplier also. The providers all use a multiplier system, which is how they see the impairment, either a 1 or 100% up, right? 100% is a fairly standard life, and so it gets it's a healthy person, and depending on the impairments, the sickness, the age, it can go up and up and up, and then you have a higher impaired life, which, depending on the impairments, means it's a riskier deal if the insured is cured or gets better, depending on what it is, and that's another risk factor that all the funds take in, right? So an LE of 8 years for an insured can mean very different things depending on what that multiplier is and how they were able to get to the 8 years compared to just he's 80 with 8 years.
So, said another way, there are certain ailments that can be cured. So if somebody has a life expectancy that is lower or shorter because they have high cholesterol, and then a statin comes out or some drug comes out that cures the high cholesterol, that person can then have a perfectly normal life expectancy. So you've now you've bought a policy based on a short life expectancy, it's a long one, as opposed to a person who's 90 years old. You're not betting on anything in particular that's going to happen to that person. They're just old, and they're going to die of old age. They probably won't die of something, they'll die with something. And so you're taking much less risk in that. You're not betting against technology, you're not betting against some specific cure. Rather, you're just betting that person is an older person. Probability of break even on investment is something that we also look at. Do you want to talk about that?
So that is your initial investment plus future premiums, the point which those two numbers equals the death benefit. And different investors look at it in a different way. A very popular one is looking at it from a probabilistic point of view. So you can look at your initial investment in the future premiums and see where on the curve those numbers equal out and decide what your probability is, right? So for most people, they want a probability of making a zero investment to be relatively low. And it's very determined on COI and how expensive the premiums are relative to the policy, whether the break even will be 20% or 3%.
Yeah, you don't want to be in a position where you're paying premiums on a policy, and even if the person passes away, you're still going to break even or lose money on that policy. You want that to be a very low percentage, which also goes to the sensitivity of LE extension, which is something you look at, and if you think about it, and we'll show this in the example, because 50% of the time people live past their life expectancy, you'd like to know what that looks like. So if the person lives 10% longer, 20% longer, what happens? What happens to the internal rate of return? What happens? And many of those are dependent. They're dependent on certain factors. How high are the premiums? If the premiums are very low, the person might live several years longer, and it won't really be a big blow to the IRR. Conversely, of course, if the premiums are very high, it could destroy the economics of it. So you definitely want to look at that. You want to look to see from a liquidity standpoint how the life insurance was originated. Was it premium finance paper? Was it originated correctly? Was there insurable interest? A lot of those issues have worked themselves out as regulation has gotten better, and all of us have gotten more sophisticated at ferreting these things out, including the insurance companies. But that is something you want to look at, not only in terms of making sure that the policy will pay out, but also in terms of its liquidity. If you turn around and you want to sell this policy on the tertiary market some years down the road, for whatever reason, you want to get out of the business or you just want to do other things with your capital, some of these factors, premium finance paper, there are some people who won't buy that. So the pool of people who will buy premium finance paper is somewhat smaller than the pool of people who will buy life insurance policies in general. So your price will probably be slightly lower for that if you go to sell it.
It's one of those characteristics where all buyers look at it a little differently and you know, price to risk for different programs, whether it was carrier disclosed or non-carrier disclosed premium finance, and what the case law around those programs and the states the programs were in has looked like over the past 5 or 6 years.
How about carrier spread, Adam?
So that's in reference to the carrier credit rating that everybody knows about. There are certain carriers that have a below A rating or below A minus that a lot of funds stay away from.
So again, this is, in our opinion, and I guess I'll just throw the disclaimer out that these are all just our opinions. We're not stating fact here, but in our opinion, the credit risk on insurance carriers is extremely low. Typically, insurance carriers have huge reserve requirements. They're often paying into state-regulated funds, and it's very, very unlikely that an insurance carrier won't pay a death claim, because if they do, they're never going to sell another policy. Basically.
It has not happened yet.
It has never happened yet. It's very unlikely to happen, because who in their right mind would buy insurance from a carrier that had ever defaulted on a claim? So the actual risk here is low, but because if a carrier is B-rated instead of A-rated, if you think about it, maybe a pension fund isn't allowed to buy B-rated paper, or some funds just say in their documents, we won't buy B-rated paper. So again, this isn't one of those things we consider a risk of non-payment. We just consider this a liquidity risk, which is if our universe of potential buyers, if we want to get liquid of this, is smaller, our price is likely to be lower, which is okay, and maybe we want to buy and hold. But just in general, we should be aware of certain things that will impact liquidity, and perhaps that requires us to pay a slightly lower price for the policy. Death benefit amount, obvious, I think.
Right. And it kind of plays into the different sizes of the funds. The investors that have less capital look at the smaller policies a lot more, right? If they can buy more lives, they get more diversification, and their analytics are a little bit tighter compared to buying one $10 million policy that will take up 40% of their capital allocation.
Yeah, in order to buy larger policies, you have to have a pretty large fund,
right,
so that you can have diversification. And so again, smaller universe. Maturity age?
And maturity age, we talked about a little bit with the probability of survival to maturity. We look at when the policy matures. Is it an older policy that terminates at 95 or 100, or does it have some sort of maturity extension rider, or pays in perpetuity?
Right. And then LE multiplier, again, is the life expectancy underwriting companies typically put a number or a multiplier on people, which generally tells you their level of impairment. So a perfectly healthy person might be 100 or a 90 multiplier, and a person with a 500 multiplier means they're really, really sick and have some real health issues. So knowing what that number is sort of another way of backing into the life expectancy. Okay, so we have a couple of case studies here, just policies we've purchased, which I think illustrate what we've been talking about. So policy A is a $1.14 million policy. It's a universal life policy. I think everybody knows what universal life is, but typically life settlements are done with universal life policies. They're the most flexible policies in terms of payment of premium, and just have been the policy of choice for life settlements. John Hancock, obviously a highly rated carrier, but carrier is important. And some of the things we even talked about in the last presentation, some carriers are harder to deal with as far as changing ownership. Some take longer in the process of the closing. so knowing which carrier you have, even beyond the credit rating, can sometimes be instructive. The other thing we do in our fund is we limit our concentration with any one carrier. So if we already have 20% of our fund is John Hancock, we don't want all of our eggs to be in John Hancock's basket. So maybe we'll pass on a John Hancock policy in favor of a Lincoln policy. Adam, why is issue date important?
Well, it's good to know when it was issued and how much premium's been paid in, and it's, the start of the policy.
Is it fair to say that a policy that's been in force longer is a safer bet?
Well, in
All else being equal?
all else being equal, it's a safer bet, and there's less risk of premium finance with older policies. There's less risk of any STOLI issues with older policies, but at the same time, there's a higher chance of the policy, like in this one, not paying past age 100. So with the older population, as they get to 85 and 90, as they're bringing these policies to market, we kind of look at both of those in conjunction with each other.
I look at it just personally, again, that, the person who's selling their policy, they took out life insurance to protect themselves. They've outgrown the need and they want to sell it. That person typically has held their policy longer than the person who took it out 2 years and 1 day ago with an eye towards selling it immediately. I feel more comfortable in the former situation, so I like to look at that. Premium payment mode, semi-annual?
With a lot of the policy characteristics as well, it helps us to know how the policy was constructed so that we can reverse engineer the cost of insurance when we get to creating our own premium stream, which later drives the value of the policy.
And we'll talk about that, premium optimization, which is a real tool you can use to get your premium streams as low as possible. So this is one of those policies that basically you stop paying premiums at 100.
As well as the policy, both the premium stop and terminates at age 100.
Okay, so this is one of those policies that if you own it and the person turns 100 in 1 day, it's worthless.
It's worthless.
Illustrated premiums to face are 3%, so the premiums are 3% of face?
So this policy, from a premium to face point of view, is a relatively cheap policy for its age.
And the person is preferred, which is going to impact the premium load. So this looks a little scary, but it's really not. So if you look at the survival curve, do you want to
Sure.
walk
So this insured is currently is a 73-year-old male, and we have both an AVS of 119 months and a 21st of 64 months. So there's a significant spread between the two, and every investor looks at that in their own way. And when you take it and you combine the two LEs, you're able to create your survival curve, which is on the left. And then we also showed the mortality table, which shows starting today in 2014, there should be, and my eyes aren't that great today, should be about 20 deaths, and then it grows over time until all 1,000 in the simulation have matured.
Right, and some people ask why would life expectancy underwriters have different life expectancies, and there is a little bit of an art to this. It is not a science. They all look at the medical records, and some of them have different ways of evaluating certain impairments. Some of them have different ways of evaluating certain lifestyle issues. There's one life expectancy underwriter that if somebody's able to go and take a vacation, they give that a lot of credit. They really look at that, and others don't think that's as big a deal. And so what you'll get back typically are two life expectancy. Well, some people just get one life expectancy, but in our case, we get two, and usually they're pretty similar, but sometimes, as in this case, you can have this. And so then people have their own ways of doing it. They can look internally and throw the one out they think is wrong. They can blend them together and average them. In our case, we tend to weight more towards the longer one, just to be more conservative and give more weighting to that.
And just to explain the survival curve a little bit, it basically says today in 2014 that there's a 100% chance of the person being alive, because when we price a policy, we assume that they're going to be alive today. And then you can look forward to about 2020, there's an 80% chance that person will still be alive. And if you get very granular on this curve, it gives you a daily or monthly probability of survival, the chance that that person will still be alive in that month or on that day.
And then if you aggregate that curve with the curve of 500 other people, you get a very smooth,
Right.
predictable curve.
So effectively, this Brown curve is saying a 50% probability of survival will be some blend between the ABS and the swing curve.
Yes.
Yes, basically what we did is we blended the two, weighted it more towards the longer one, and came up with that curve, which is exactly right.
So on this policy, we always require, when we're evaluating policy, a few basic documents from the agents. The LEs, medical records, corresponding HIPAA, and then a current in-force illustration. And this one showed that the policy had a starting account value of both of $216,331 for the account value and the surrender value. And with that data point, some of the other data points from the illustration, we're able to reverse engineer the COI and then create an optimized premium stream from that.
Just to explain that, he does this every day, so I'll give you sort of the layman's terms. So COI, of course, is cost of insurance. And when you have a universal life policy, typically there are what you're paying, some of what you're paying is to keep the insurance in force, and then some of what you're paying are for other things like account value and things of that nature, which we don't care about because we're not the policyholder, we're not going to borrow from this policy. All the things that a typical insurance owner might do, we are simply interested in stripping this down to just the cost of insurance. So with some reverse engineering and expertise, we can do what's called premium optimization, which is to say we can figure out the minimum level to pay to keep the cost of insurance in force. And although you get a bill that says you owe $20, in fact, if you pay $15, that will keep the policy in force with just cost of insurance. It won't give you some of those other bells and whistles, which a person might want, but a fund or an investor probably doesn't want. So in this case, as you can see, because there was this account value, it turns out that we don't have to pay any premiums for the first 5 years. So you see from the first curve to the second curve, that's a 0 for 5 years. And then it actually kind of goes up and becomes fairly similar. So in that way, this policy is attractive in that, for the first 5 years, you're not putting any more into it than the purchase price. And there is some possibility the person could pass away within those first 5 years, and you will have paid no more than the purchase price for it. So what we normally do then is we extrapolate this information and take likely outcomes, Monte Carlo simulations, what have you. We put the money we'll have to put out in terms of premiums, what we'll get back, some timing, a discount rate, and then as you look at that, you'll see from an internal rate of return perspective what you'll get. So if at a 14, you can pay $316,000, 16 and 18, you can see those. And so as you look at those, you'll look at the market, and the market moves around, but typically it's in the mid to high teens. And people will bid based on whatever their methodology is. So you might have somebody who values this, the way we do and bids $285,000. Somebody may have bid just off the shorter LE and thinks it's a much more valuable policy and might bid a lot more. Somebody might bid less, and so the auction will sort of go there. And people value some of the differences. One thing in this policy, which you may have noticed, which is something we look at somewhat askance, is that there was a big difference between the two life expectancies. And so some people look at that and say, no big deal, I'll average the two. We look at that and say, somebody's obviously wrong here. And if somebody's wrong and we don't know who's wrong, that's a problem, because if you go with the aggressive one and the shorter one, it could just be that life expectancy underwriter was wrong. Somehow, we're much more comfortable when there's a consensus of opinion between the two. That's why we get two. And so just in general, even though we can account for it, we don't love the fact that there was a big spread here between the two. Anything to add to that, Adam? And then just on the low premiums, that's where the underwriting status of the original insurance policy comes into play. If you were preferred when you got this insurance policy, your premium stream is going to be lower, which is a good fact. So even though it's not really that important now, because now we're evaluating the health of the person as they stand today. What their health was when they took out the policy is important because that's what dictates the premium stream going forward.
Quick comment. So if I'm looking at this correctly, and I have a policy that has a large cash surrender value in it, the insured could effectively surrender that policy for that amount, for let's say the $216,000, or they could come into the settlement market and get an offer of $316,000 and effectively minus fees make $100,000 for the sale of their policy. In this example, is that what you're laying out?
Yes.
Here, okay. Just want to double check on that. Thank you.
And typically when you're purchasing a policy, if there is cash value in there, you'll take that into account into the offer. So then typically what we'll do then is, as we said, well, what will happen if this person lives 10% past this blended life expectancy? And so in this particular case, it actually doesn't have as much of an impact as you might expect because the premium load is so low. In fact, it's 0 for 5 years. Whereas if the premium load was very high, every month and every year that person lives past when you expect them to, it's going to have a real impact on your internal rate of return. So this is not a real risky policy. It's a very low probability of breaking even.
Right. On this policy, the only true risk is looking at the probability of reaching a maturity date, or age 100. Outside of that, depending on how you look at the LE spread, everything else checks all the boxes as a good policy to buy and to pay a higher price for.
You want to talk about policy B?
Yeah, so this policy, it's 1.3 million. It's a younger policy issued in 2001.
Not younger in terms of the age of the insurer, but issued
Right.
more recently.
The policy, you stop paying premiums at age 100, but the policy will pay the death benefit till age 110. The premium to face ratio is much higher, so it's a much more expensive product from Lincoln National.
And it was a standard rating, so from the very beginning, the person had a higher premium load.
Right.
But we don't have that very big risk factor as much in this policy because the policy stops paying at age 110, and it's it's much less likely that someone will reach 110 than they will reach 100.
And so when we received the policy, it was on a 92-year-old male with a 31-month AVS and a 28-month 21st. So the spread between the two LEs was much less. So we didn't have that concern about a difference of underwriting opinion. But the multiplier was lower, so you're looking at a fairly healthy 92-year-old.
Right.
And then additionally, so this policy also differed from the first in that there was very little value already in the policy with $8,000 of account value and no cash surrender value. So from an investor point of view, you're taking on a premium liability the first day that you buy the policy.
So there's not much you can do here to optimize. And if you think about it, it's more likely to get this kind of scenario. If somebody has a lot of account value in their policy, typically what they can do is stop paying premiums and let that account value pay the premium. So they don't really have a problem yet. Usually what they get motivated to sell is when they get that premium bill that they actually have to write a check for. That's when typically, I don't know, Adam, would you agree with that?
Yeah, I think so. I think that for policy owners, as long as their expectation on how long the process takes, then they should be okay. But nobody wants to start exploring a life settlement and have to pay 6 months of premiums when they thought that they were going to lapse or surrender the policy the next month anyways. Especially if they don't know what type of value they can get from the market.
So here again, we look at it with the various IRRs. And again, what we're willing to pay in some respects depends on the riskiness of the policy, what we see, what the liquidity profile is. Do we think we'll be able to sell it? Some of those things, although we're typically buy and hold. So because this policy is somewhat near its maturity date, it's got high premiums right from the start. You do have a little bit of a higher probability of breaking even here because the person is older.
And with many products, the older the insured, especially after they reach 90, the premium, the cost of insurance rates increase very quickly. And that causes any type of life expectancy extension sensitivity to be a bigger concern for investors. So in this policy specifically, while the LE was relatively low, under around 30 months, if it went a little bit past that, that one extra year of a high premium payment can drop the value significantly for the investor.
You know, said another way, if it's a shorter LE, an extension is a higher percentage of that LE. So if you have a 1-year extension on a 10-year LE, that's a 10% extension. If you have a 1-year extension on a 2-year LE, that's a 50% extension. So,
Right. And so this slide shows how, and can you go back to the first? Right. So we dropped from about 573,000 into 14% IRR to, on the next slide, 517,000 from extending the life expectancy 10%, which is, you know, in months, 10% of 30 months is a relatively short extension, but it drops value significantly for the investor.
also because of the high premiums.
Right. So we wanted to put the two kind of side by side just to show some of the issues. You can, if you look at the break-even probability on the shorter policy, while you're paying a lot more for the policy, you know, the investor's taking about a 22% chance that they'll break even on their investment compared to on the first policy that had a much longer life expectancy. There's, you know, less than a 3% chance that you'll break even or lose money on this investment.
So from this perspective, as you look at these in your bidding, you might be more willing in policy A to go up to
Right.
a lower IRR.
Right, and then on the 10% LE extension column, what we're basically showing on policy A is that if the LEs extend by the 10%, then our 16% valuation drops by 3.6%. So that's not too bad of a risk compared to on the other one where our 16 can drop by 5.2%.
And because of the high premium load, if you go out to 20%, it's going to get dramatically worse.
Right.
So this is, I mean, obviously, I think, you know, the age of the person, the health of the person, you know, the life expectancy, these are all very obvious factors to consider. But as you look at some of the things that maybe weren't so obvious, you know, how long the policy's been in force, what the rating was on the person when they first got the insurance, optimizing premiums, how well you can do that, and then risk factors like risk of breaking even, risk of not being able to resell the policy, and those things that can really educate a person on what types of policies you want to look for, and then you get into the market and you see how other people are evaluating it. And the great place to be is where you're evaluating a policy based on factors that other people don't see, and therefore you can get great deals. Whereas if you're looking for middle of the fairway, small face policies with short LEs in this particular profile, and that's what everybody else is looking for, you're going to have to bid those policies up. If you're looking for policies that have different characteristics and you can evaluate some of these subtleties, you can be in places where everybody else maybe isn't.
And with everything that we look at when we do all this analysis, it's all really based upon the information that the producers are gathering at the beginning of the transaction, right? So the more information that we get, the more precise we can be, and then that allows us to get tighter on our yields and pay a higher price. A lot of the times, you know, if we have an illustration that is 7 or 9 months old, or we don't have the contract to actually read the language of that product, then we have to make general assumptions along with adding buffers into our pricing. So, you know, we're going to pay less after we acquire the policy. We'll get what we wanted anyways, and then, you know, either we have the buffer and it ends up being okay, or we get the policy at a better deal than we thought. But it's one thing that we always ask for when we're talking to producers or life settlement brokers is, please get us updated information, call the carriers. You know, a new VOC tells us a lot of information, a verification of coverage or annual statement tells us a lot of information that we're able to use to do both our risk analysis and our valuation.
So as people come to us, whether they're brokers or agents or whomever, and want to use Magna to originate policies, you know, typically you'll give us a buy box and say, these are the parameters. I don't want people under this age, over that age, certain things like that. And we can help you develop those parameters. And then within those parameters, we'll be out in the market, you know, bidding on your behalf and looking to make purchases that fit those parameters, using some of these techniques, helping you with premium optimization, helping you evaluate some of the risk, making recommendations and that kind of thing. So obviously, you know, in the secondary market, you have to have a provider. And even in the tertiary market, it is a good idea to use somebody to help you with pricing, analysis, due diligence, making sure that the policies are what they say they are, making sure that the people really own those policies, that they were originated correctly, and that kind of thing. So with that, we know it's been a long day, but if there are any questions, we'd be happy to answer them.
When you're looking for specific types of policies, do you let the other brokers know what you're looking for so they can provide the policies to you, or do you just kind of wait it out and see what comes to you so that way they don't know?
So we have a very broad buy box, and it's kind of based off the initial risk slide, right? We were looking for policies between 100,000 and 10 million a face, and 65 years and older, you know, those type of data points. You know, Magna has both captive capital from Vita as well as outside funding sources, and so all of our different funding sources have a much tighter buy box within our broad one. So we're always going out to the market and saying we're looking for something in this box, and then we funnel the policy internally to the appropriate buyer.
But you know, if somebody came to us and said, look, we want jumbo policies, we want as many $10 million policies as you can find, we'd call Asher and Welcome and all the brokers and all of our sources of policies and say, okay, we're really now heavy into the market for this type of thing, show us everything you've got. And that might generate more supply in that particular avenue if we do that. So we would do that. But generally, we're a fairly diverse buyer because we have so many clients that, you know, that are typically looking for different things. Any other questions?
Well, thank you, Dan and Adam.
Thank you very much.
Uh-huh.